Savings Cell, Financial Literacy Made Simple. Welcome to Savings Cell, where we help you master your money one smart decision at a time. Don't forget to like, subscribe, and let's sail toward financial freedom together. The topic that we are going to cover today is liabilities. What are liabilities? It's the hidden side of your money. Ever wonder why you feel broke even when you are earning more? The answer might be hiding in your liabilities. Whether it's credit card debt, student loans, or even that new car payment, liabilities quietly pull your finance backward. In simple terms, a liability is money you owe. It's the opposite of an asset. While assets bring your money in, liabilities take the money out of your pocket. In more technical contexts like accounting, liabilities are obligations that must be settled over time through transfer of money, goods, or services. So it doesn't limit to only just cash. Think of it as anything that requires you to make future payment. In short term, that includes credit card, utility bills, buy now, pay later apps. In long term, that would be mortgage, student loans, and auto loans. Now, there are many ways to categorize liabilities. Some people might call them short-term or current, or long-term and non-current. The current liabilities are debt that you must pay within a year. Think about credit cards, rent, monthly subscriptions of all your favorite services. Non-current liabilities are the debt that stretch beyond a year, like student loans or mortgage that you have to pay back. Now, it gets interesting. Not all liabilities are bad. Some can help build wealth if used wisely. For example, what we consider smart debt is when you take student loan with good term for high-income career. Another example is taking out a mortgage to buy a home that increases in value. That can be a strategic move to build wealth with liabilities. However, buying the latest phone on credit just to impress your girlfriend is not so much a good debt or smart debt. Now that you are more familiar with liabilities, let's move on to the more advanced types that they are categorized into. You will often see this term used in finance and business world, and if you are planning to grow more in financial literacy. Let's say that you have your own restaurant or a factory. You're running low on cash, but you need ingredients. Fortunately, the suppliers and you are very good friends. So, they allow you to order eggs, then pay later. In this case, your liability is accounts payable, or money owed to suppliers for goods or service bought on credit. Next is accrued payable. At the end of every month, you have to pay your lovely staffs. That's accrued payable. Costs like salaries that you have incurred but haven't paid yet. This is similar to utilities bills like electricity, internet, water, gas in your daily life. Lastly, this one is particularly interesting because you make money, but it becomes liabilities. For example, you sell gift cards in your restaurant. In accounting, the money you earn is not an income yet because you have to deliver service later. This is deferred revenue. It will only become officially income when you already deliver your service. So why liabilities matter? Reason number one, Liabilities affect your net worth. That's your total assets minus your total liabilities. They also affect your credit score, financial freedom, and how quickly you can save or invest. Let's pull out the old school blackboard. The formula is net worth equal assets minus liabilities. For example, if you own $50,000 in assets and owe $30,000, your net worth is only at $20,000 at the end of the day. Reason number 2, think like a business owner. You cannot run your business without liabilities. Naturally, we all want to avoid that. It is something that is scary by its nature. But that is impossible in finance world. It is crucial for business operations. Most companies rely on liabilities to finance day-to-day operations, expand, and buy inventory. In fact, accounts payable can even improve company efficiency if used correctly. So how can we manage liabilities? Here's how to handle liabilities like a pro. For beginner, starting with tracking your debt. Know exactly what you owe and when you have to pay. Number 2, avoid lifestyle debt. It is easy to cut. Do not borrow to look rich. There are liabilities that you have ability to cut back instantly, and in fact you should. Number 3, build an emergency fund. When emergencies hit, most people rely on credit cards and loans. But with an emergency fund, you can have a financial cushion ready for whatever gonna happen. Pay for the surprise expense with your own saving. 4. Prioritize high-interest debt. It is a common strategy to tackle credit card debt first in case that you have many liabilities, because this debt gonna grow over time. 5. Consider consolidating high-interest debt. This means combining them into a single lower interest loan. You can even try to negotiate for lower rate. 6. Ask yourself these questions before starting payment plan on credit card. Is this a want or a need? What's the total cost after the interest? Will this payment limit my ability to save or invest elsewhere? Liabilities are part of life, but understanding and managing them put you back in control. Even though we encourage you to save money on a regular basis, being mindful of your liabilities isn't about avoiding debt altogether. It's about making liabilities serve your bigger financial goal. If you learned something new today, drop a comment and share this video with a friend who needs it. He might be the one that grinding to build his own wealth. Saving Self, financial literacy made simple. Please don't forget to like, subscribe, and let's sail toward financial freedom together.